Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. Today, for an 8th year, we're dipping into the UBS Global Real Estate Bubble Index, the annual report that brings an up-to-date take on global urban housing markets and gauges the bubble risk in residential property in 25 major cities around the world. What characterises the scene set in the 2024 edition? As we'll hear from our expert panel, bubble risk in housing markets declined further over the past 12 months. That's a decrease for the second consecutive year. Why so? Well, inflation-adjusted housing prices in the cities analysed are now, on average, roughly 15% lower than in the middle of 2022, when interest rates started to surge globally. As we'll hear, the cities recording the strongest price corrections are those that displayed a higher risk of a real estate bubble in previous years. Our panellists are here to share their insights and to explain why the momentum in the housing market could be said to improve. So, let's hear from those guests. We start with Matthias Holzhey, GREBI Editor-in-Chief and Senior Real Estate Economist in the UBS Global Wealth Management CIO in Zurich. Matthias, always a pleasure to welcome you back to the programme to talk about the index. It's the 10th edition, no less, of the GREBI. But before we get into the detail of this year's edition, what kinds of metrics and things are you looking at? Again, some of it is, I guess, intuitive, but you build all kinds of really, really interesting data sets, some of which obviously we'll talk about in a second. But in case we've got listeners maybe who haven't read the report before or heard our discussions, tell us sort of some of the metrics and how you calibrate all of these findings.
Okay, the basic purpose of the model is to quantify the risk of a housing bubble. What does that mean? And that's something which is not very clear sometimes, but we try to frame it as if you're in a housing bubble risk, or you have a high housing bubble risk, first of all, that means that you should be cautious in a sense, you should not over leverage, and you should not expect too much of real house price appreciation in the future. So basically, it's a metric of the probability of a house price decline, house price maybe not collapse, but at least that you have a negative expectation for a real house price growth. Now, how do we come up with the results? What we do is basically we compare, for each city, we compare the housing market to its own history. Okay, we look at how did house price develop compared to rents. I mean, that's one of the key pillars. We look at affordability. We look at how did house price develop to local incomes. Can anybody still afford to live in that city? We also look at how did the city do, mostly compared to the country. So if a city suddenly becomes the star, let's say in a country, suddenly everybody focuses on that specific city, then this is sometimes a risk of a housing bubble. And then we also look at, let's say, real economic factors, and we look at mortgage growth in outstanding mortgage volumes compared to GDP. So basically we look at household leverage. We know that it was always a sign of a housing bubble if households started to leverage up progressively. And finally, we also look at construction. If there is overbuilding in a city, which rarely happens, but this would also be a significant risk of, let's say, future house price corrections.
Well, let's jump in then in more detail, Matthias, and talk a little bit about the 2024 edition. And I guess a headline to sort of slightly truncate the hugely complex findings. The risk of housing bubbles in most of the cities, on average, have decreased again, right? And that's 2 years running. Is that the big headline?
Well, it's one of the headlines. It's a bit complex this year. I mean, we had a shift of the risk out of Europe towards the US. I mean, that's one of what we've seen. Risk increased in most of the US cities, and it declined further in the European cities. In Asia Pacific, it was mostly stable. I mean, Hong Kong was very weak, but the other cities held up quite well. Tokyo is still doing very well, in a sense, if you would say rising house prices is doing well. And that's one of the headlines. Another one is that the house price correction, even in Europe, seems to be over. I mean, I think that's a second message we can give. And so if we look going forward, we are first time ever, we are in a sense optimistic about housing markets, and also in a positive way optimistic in the housing markets. We believe that depending a bit on the economy, we can for the first time, we not focus only about risk, but also about opportunities in the next couple of years.
Now, you talked about housing provision. Just tell us a bit about housing stock and shortages and how the shortage can, and indeed, look, the data suggests it is acting as a stabilizer on the market. Unpack that a little bit for us, Matthias.
I think now it's a good time maybe to look back a bit. Okay, look at 2022 and then to discover a bit what lessons can be learned from the last 2 years. And I mean, the house price developments across cities has been hugely different. And it's not easy to explain those, okay? Because interest rates increased close to everywhere. Affordability was very bad everywhere. So the question is then, why do prices held up well in the US, but why did they held up well as well in Sydney, but have been very weak in Stockholm? Sydney and Stockholm as both have very variable short-term funding, for example. Everybody is highly leveraged and so on. But in Stockholm, prices are 25% lower. In Sydney, they are more or less at the same point where they were in 2022. And here I think that the housing shortage is one of the explanatory factors. If there is a very pronounced housing shortage in a city, if you have a very strong population growth, if you have still strong demand, let's say for investment, for touristic purposes as well, if you buy to let market, in the Airbnb market, then financial affordability didn't really matter. So that's why markets like Sydney or Madrid held up quite well, while others where housing shortage is less an issue, like in Germany, like in Sweden.
So then, what does all that mean for the broader direction of travel, Matthias?
Financing does matter, but it's not the main culprit, it's not the main risk. Okay, even your households have no long-term financing or just based on, let's say, money market mortgages, that can be okay. It just depends a lot on the market. And if the housing shortage is really extreme, you don't have a choice. You just have to scale down your consumption of housing space. And then house prices will not fall, at least not in this kind of period. I mean, if interest rates would remain at the current levels, let's say for another, let's say 2 or 3 years, then I would say you would see more housing weakness across the globe. Okay, but for such a rather short period of time, in very tense markets, in markets where rents are increasing sharply, you just don't have an option.
And what about the big picture? If we zoom out a bit, Matthias, and look at the kind of big takeaway in terms of the momentum across all the market, a sense, I guess, in the piece that, the tide is turning. You've alluded already to financing costs becoming more attractive, of course, demand bottoming out, that we could see some price acceleration. How sort of broadly optimistic do things look or otherwise? And I wonder, more broadly than that even, looking at, growth, what role does sort of broader economic growth play in setting the direction of travel in terms of price dynamics and so forth?
I mean, we have also seen that economic growth has been not a decisive factor in determining house price change in the last couple of years. I mean, the US economy has been very strong continuously. It has been is growing continuously at 2.5%. If you compare that to Germany, where economic growth collapsed, and this has a profound impact also on household expectations on future house price growth, and that's also why people have become more cautious when it came to purchasing homes. So it's a bit, I think, too early to call out the next housing bonanza as interest rates fall. In the US, for example, we expect much stronger economic growth in the next year, in 2025. And as a result, we will not expect house prices to accelerate there. There will be much more, for example, with lower rates, you will suddenly have much more supply on the market. And much more supply typically means lower prices. So for the US, you're much less optimistic than, for example, let's say in Sweden or in Germany, where we expect some rebound happening. Now with a recovery of the economy and lower interest rates.
In terms of how the Grebi gives this incredibly deep data-based snapshot of where we're at now in these different markets, how useful is it as a tool for the future of direction of travel, Matthias? I guess that's what I'm trying to say. And that must be conversations that you have, I guess, with clients who say, wow, yeah, I get this. This is a really clear picture, but what should I do now in terms of the investment picture? How useful a resource is it? And how should people incorporate this into their actual investment and portfolio planning decisions?
I mean, first of all, we have to be very clear. House price levels have not adjusted fully to the higher interest rates in no city, okay? So housing is financially not really affordable, and house price level is not sustainable at current interest rates. So we really need this rate cut cycle coming to sustain house price levels globally. But that's also this expectation of lower interest rates is so entrenched also in households, financial markets. Everybody believes now that this is coming. So, and this expectation is already now been helping to accelerate house price growth, at least in nominal terms, in many of the cities which we have on the radar. For investment purposes, okay, now it also becomes interesting because on the one hand side, okay, you see that house price growth, and also you can also take this over to price change for multifamily apartments for residential investments has bottomed out, or is set to accelerate slightly, or recover at least. And at the same time, you have a profound housing shortage in most of these cities. And this is set to worsen because as a side effect of the high interest rates, we see that building permits have been declining or still declining in close to all the cities we have on the radar. I mean, not everywhere. Dubai is a big exception. And in some cities, you can just build and build and build. But let's say in the European cities, to some degree also in the US and in Asia, we have a decline in building permits. And given that population growth in the cities has been recovering from the pandemic, say outflow, from the move to the suburbs or whatever, but so people are back and there's less supply, so we have rising rents. And together with the broad, let's say, body lower interest rates, which will stabilize prices and drive prices up, I think this is quite, residential investments become suddenly quite attractive.
Matthias, we're going to hear about Dubai in just a second, but let me get a quick thought from you on Miami before we do that. Let's head to the US.
Miami is maybe the only very interesting market. They're really very cautious now because, it's really too many wealthy individuals are competing for a limited number of seaside properties and driving prices up. And then if you think about climate change in the future and the risk that this is being flooded all over with a lot of negative side effects, then I would not be too optimistic about the long-term price appreciation here in Miami. But I think that was the second point, just maybe coming back to the 10-year anniversary we're having. I could also say, if you look back at the first edition, I mean, we had London and we had Hong Kong at bubble risk at that time. And both cities are now on moderate or even low bubble risk territory. Okay, prices are in both cities in real adjusted term, inflation adjusted term, back to the levels 2013, 2012. This sounds maybe depressing, but on the other hand, this is a very good development for people who actually live there. It may have not been significantly more affordable, but at least the market is not overheated anymore. At least the housing market becomes maybe sounder, it's more sustainable currently than it was 10 years ago. So I think sometimes we like the hype, we like the high scores, but for people who actually live there, it's much better to have a low score in the housing market than a high score.
Matthias Holzhey. Well, let's get that Dubai view now from Fahd Iqbal, UBS CIO for the Middle East. Fahd, welcome to the programme. Before we look at Dubai, just give us a broader overview on the wider Middle East region first up.
So for the region as a whole, it's really been the UAE which has been in focus from a real estate perspective, because it's the one market which has the most accessible real estate. It has excellent liquidity. It's got very good breadth and depth. And you also have a legal framework that's been tried and tested and been used. And because of the mixture of all of these factors, you end up having a real estate market which is attracting significant attention from both domestic residents, expatriates, and also from foreign buyers too.
Yeah, and it's always instructive if we look at Dubai, where, of course, you're sitting chatting to us now, Fahd, a lengthy sort of price correction. And there was a sort of low, if we look at the sort of bubble risk, low signals back in 2020. I guess before we dip in much more detail, just tell us a little bit about what's happened since then in terms of how things are tracking.
Gosh, there's been a lot that's happened since 2020. I mean, it was a serious turning point for the Dubai economy, because being here on the ground back then, and I think it's fair to say that anywhere in the world you were at 2020, it really felt like this is a point where we're facing an existential crisis, or you're facing a situation which has never been faced before. And the level of uncertainty was incredibly high. What happened in Dubai specifically was really a function of the fact that the government here, because it's always been historically a trading hub, it's been a commercial trading hub, and it's a very business-minded city, it's a very business-oriented government, and it's a very fast-moving, flexible government as well. And they were very quick to put into place changes and regulations and policies that allowed for the city to reopen fairly quickly after the impact of COVID, which really led to a significant recovery, led initially by tourism and then broadening out to the rest of the economy itself. Perhaps the biggest change that we saw, really, the one that provided the paradigm shift for Dubai, was the fact that we saw the launching of long-term residency visas here in Dubai, which are otherwise known as golden visas. And you also saw a change to the local legal system that allowed foreigners to own 100% of businesses that are onshore. Previously, foreigners could only own 100% of a business if it was in a free zone or offshore, so to speak. And that's really what created a significant shift for the UAE and Dubai in particular. So both of these factors, both of these legal changes essentially laid the groundwork for building up an economic cycle in the UAE and Dubai, especially, that was less dependent on government infrastructure spending, which was a key driver for previous economic cycles. And it led to a real estate cycle less dependent on what I would refer to as hot money, and instead being a lot more dependent on long-term residents. And that's ultimately what has helped, one of the things that has helped the real estate market here become a lot more mature versus what we saw back in, the early and mid 2000s, where it did have a little bit of a Wild West feel to it.
Finally, let me ask you about increases in supply, Fahd. Now, people who know this market well will know that it expands, and it expands at a relentless pace. There was a really arresting data point which you put in the piece. I think, is it by it might have been 2030, might even have been by 2029. Housing stock will have grown by a third, which is pretty extraordinary. Does it follow from that, therefore, that if we think about long-term price appreciation, there may be some question marks given that relentless pace of growth in terms of housing stock?
So certainly, that's going to have an impact on price appreciation. The way that we've seen supply and demand move in the Dubai real estate market, because it's still a relatively new market, they don't really move in sync as you would normally have in perhaps other more well-developed markets. But what does distinguish Dubai significantly is really the scale of supply increases, as you mentioned. You do not see that occur in more developed markets where you have significant housing shortages because the pace of construction activity is simply so slow. In Dubai, it does operate at breakneck speeds. I mean, if I look at what your sort of quarterly delivery of housing units is over the course of, let's see, since I would say about late 2019, you've been averaging about 10,000 units a quarter. It did drop a little bit in 2022 to about 6,000 or 7,000 units a quarter. But, that gives you an idea of just how much is coming out. And it has accelerated in response to the launch of off-plan properties, has accelerated in response to the sheer level of demand. And because there's a time lag between when these projects are announced versus when they're delivered, they do tend to be announced when demand is running extremely strongly, which means that over the past couple of cycles, they've essentially been delivered when demand has peaked and has started to come off. And that has exacerbated downward pricing pressures in the previous two cycles. No doubt there will be elements of that next time around as well. So yes, to an extent, there are concerns in terms of long-term price appreciation. But I would stress that this market has really turned a corner courtesy of those two legal changes I mentioned earlier, which allows for longer-term buyers to come into play. And I think that's really making this current cycle, it's setting it completely apart from the previous two, because it is, in my opinion, marking a long-term inflection point. If you look at prices since 2003, up until, COVID, essentially, prices had been moving in this very wide but ultimately sideways range during that time. I think where we are now is really the beginning of a longer term uptrend. There will be ups and downs within that uptrend, but it will be an uptrend because Dubai has now successfully positioned itself as a place where you can engage in work, in business, and in residency from a long-term perspective. It is going to be competing with other similar hubs, be it places in the Americas or in Europe, or indeed in Asia. It has become a proper global hub in that respect. So while there may be downward pricing pressures in the future because of, there is going to be a significant increase in supply, it's going to happen within the context of a larger uptrend over a longer term period of time. So I think depending on how you look at it, yes, you can have nervousness about what sort of negative effect the supply can have on prices. I would argue that if you take the longer term picture in terms of how Dubai is developing and what it's going to become over the next 5 or 10 years, The kind of prices that we've seen prevailing in the last few years, I think we will struggle to see them again. I think we're going to see a very different Dubai 5 years from now, 10 years from now, one that's more mature and one where prices are a bit more comparable to other more developed, more mature global hubs.
Fahd Iqbal, and before that, Matthias Holzhey, bringing us to the end of this edition of the show here on Monocle Radio. You can listen again and explore more at monocle.com. That's where you can join the club and subscribe to Monocle magazine. You can also follow this programme wherever you get your podcasts. And don't forget to discover more and find out how UBS can help you by visiting ubs.com. I'm Tom Edwards. Thanks for listening.